Before the market opens, the room is already awake. The screens are quiet, but nothing in the room is truly still. Futures are moving before most people have touched their first coffee. Headlines are stacking in the corner of the monitor, each one waiting to become someone's reason for changing a position. Somewhere deeper inside the firm, a research note is sitting in review, not yet public, not yet powerful, but already close to becoming something larger than a document. For now, it is only a file. In a few minutes, it becomes a signal. A buy-side analyst will read it before the morning meeting. A portfolio manager with real capital at risk will compare one paragraph against assumptions already built into a position. Someone else will forward the summary to a team that does not have time to read every page, but does have time to ask the only question that matters. Do we trust this? That is the real business of equity research. Not just predicting stocks, not just changing price targets, not just explaining earnings after the numbers have already moved through the market. It is the slow construction of trust around a view. A view with a name attached. A view that can shape conviction, adjust risk, and become part of how large pools of capital explain their own decisions. But before your name can sit on that view, the system starts you somewhere much smaller. Not with authority, with a model. Level 1, the model keeper. At the first level, you do not own the call. You maintain what sits underneath it. Your day is built around spreadsheets large enough to hide problems in places no one notices at first. Revenue assumptions sit beside segment margins. Working capital schedules sit beside share counts. Guidance ranges, consensus estimates, and tiny cells begin to form the hidden skeleton of a public opinion. Each cell looks harmless until one of them is wrong. Your name is not on the report. Your voice is not on the client call. The market does not know you exist. But the report depends on the work you touch. You learn that accuracy is not a talent. Accuracy is a process. You check the filing against the model. You check the transcript against the filing. You compare the company's new guidance with the exact wording from last quarter. You check the same number until it stops feeling like a number and starts feeling like something the entire structure is leaning on. Most people will never see this layer. If everything is correct, nothing dramatic happens. The report goes out. The analyst sounds prepared. The client receives the view. The machine moves smoothly over your invisible work. But if something is wrong, the silence breaks. A small error can travel upward into a note, then into a client conversation, then into a position sized with real capital behind it. That is the first rule the system teaches you. Power does not begin with a strong opinion. It begins with not damaging the infrastructure other people trust. After enough time inside the model, something changes. You stop seeing the numbers as isolated facts. You start seeing their shape. You notice when one part of the machine moves differently from the rest. Level 2, the pattern finder. At the second level, you are still not the voice, but you are no longer only maintaining the structure. You are watching it. A margin line expands when the rest of the business does not support it. Inventory moves in a way that feels too clean. Cash conversion weakens while the headline numbers still look fine. Management repeats the same phrase from last quarter, but this time, the surrounding data does not match the confidence. No one tells you to look there. You look because you have spent enough time inside the details to feel when the rhythm changes. The spreadsheet is no longer just a task, it becomes a map of pressure. Every assumption connects to another assumption. Every company number reflects a supplier, a customer, a channel, a cycle, or a decision made somewhere outside the spreadsheet. One evening, the office is thinned out, and you are still comparing the latest numbers against the last 6 quarters. Nothing on the surface looks dramatic, but one line keeps pulling your attention back. It does not fit the story the company is telling. So you rebuild the history. You check prior quarters. You compare the language. You trace the movement through the model until the pattern is no longer a feeling. It is evidence. And evidence, handled carefully, can change how people look at you. Not immediately, not publicly, but inside the machine, someone begins to understand that your judgment may be useful. That is when the next door starts to open. Level 3, the trusted associate. At the third level, the system does not hand you authority. It gives you proximity. You are invited into rooms where the language changes. The same company that sounded simple in a press release becomes more careful on an earnings call. The same executive who spoke confidently on stage becomes more precise in a private meeting. Certain questions receive full answers. Others receive answers that look complete until you read them again. Your job is no longer just to record what was said. Your job is to understand why it was said that way. You sit beside senior analysts and learn how management protects its narrative. You watch how a CFO responds when the question touches a weak part of the business. You notice when an answer becomes narrower than the question. You notice when a pause does not mean confusion, but calculation. No one announces that you have moved up, but the access itself is the signal. The system has decided you can see more without becoming dangerous to the process. You are still not the primary voice. Your name may still sit below someone else's, but you are no longer completely outside the room. That creates a different kind of pressure. When you see more, you also learn that not everything should be said immediately. Some information is incomplete. Some conclusions are early. Some patterns are real, but not strong enough yet to survive public exposure. Judgment is not only knowing what matters, it is knowing when the evidence is ready. And once people trust that judgment, your role changes again. Trust creates permission. But permission is only the doorway. The next level begins when your name starts to carry weight. Level 4, the named analyst. At the 4th level, your name enters the system, not as decoration, as a point of contact. A report goes out and your name is attached to part of the coverage. A client reads it and does not call the senior person first. They call you. Not because the title on your email changed, because in that moment, you are the person closest to the question they need answered. That is the real promotion. The firm may describe it with official language. New title, more responsibility, broader coverage, more client exposure. But inside the machine, the change is simpler. Attention has moved. Someone managing capital now believes your view is worth hearing directly. A portfolio manager calls before earnings because consensus feels too comfortable. A buy-side analyst asks how a supplier issue could move through margins. A client wants to know whether the market is missing something or simply overreacting. You answer carefully, because every answer now leaves a trace. When no one knows your name, Mistakes disappear into the machinery. When your name starts to matter, judgment accumulates. People remember whether you were clear, whether you were early, whether you changed your view for a reason, or because pressure moved around you. Reputation is not built by sounding certain. It is built by being useful under pressure. But reputation alone is still soft. It lives in memory, calls, inboxes, and quiet client preferences. The system needs a way to measure it, to compare it, to turn private trust into a public signal. And that is where the scoreboard begins. Level 5, the ranked voice. At the 5th level, reputation becomes measurable. Until now, your value has lived in private places. A client remembers a call you made before earnings. A portfolio manager forwards your note to the rest of the team. A buy-side analyst keeps your model open while comparing it against their own assumptions. But the system does not run on memory alone. It needs a scoreboard. In equity research, that scoreboard is ranking. Clients do not only read your work, they evaluate it. They compare it. They decide whether your research changed their process, protected them from a bad position, gave them a useful question, or clarified a risk before the rest of the market understood it. Then they vote. And those votes are not abstract praise. They sit inside a commercial structure. The clients who vote also direct trading commissions. Their attention has economic weight. Their approval tells the firm which analyst is producing research the buy side actually uses. This is where reputation becomes a number. And the number changes how the institution sees you. You are no longer only someone with good judgment. You are someone whose judgment can be ranked, defended in compensation discussions, sold internally, and used as evidence that the firm owns a valuable relationship with the market. But the hidden cost is precise. You no longer need to be merely right. You need to be right in a way clients remember. Useful when they are uncertain. Clear enough to be repeated inside their own meeting. Distinct enough that your name survives beside the idea. Ranking does not simply measure ego. It organizes attention. And once attention is organized, access begins to change. Level 6, the sector authority. At the 6th level, doors open more quietly. No one announces that you have become a reference point. You notice it through small changes. A portfolio manager who once gave you 20 minutes now gives you an hour. A company that once routed your question through investor relations now makes a senior executive available. A management team answers carefully because they know your interpretation may travel farther than the meeting itself. This is authority. Not loud authority, not the authority of a title. The authority of being taken seriously before you speak. Your work no longer explains one company in isolation. It helps frame the sector. A margin change at one firm becomes a signal about suppliers. A guidance revision becomes a question about demand. A small shift in language becomes evidence of pressure moving through the industry. Your access improves because your reputation has improved. And your reputation improves because your access gives you better questions, better context, and better timing. This is the loop. Trust creates access. Access creates information advantage. Information advantage creates stronger judgment. Stronger judgment creates more trust. But influence is never neutral. A cautious sentence can slow enthusiasm. A confident sentence can reinforce conviction. A small change in tone can affect how capital interprets risk. A paragraph written to clarify uncertainty can be read by a client as a warning. At the lower levels, your mistake damages the model. At this level, your judgment can shape how other people behave. And once capital begins to listen to you, the question is no longer whether you are influential. The question is what your influence costs. Level 7. The public accountability holder. At the 7th level, influence becomes heavier. By now, people listen when you publish. They may not agree. They may argue with your assumptions, question your target, or push back on your interpretation of a quarter. But they read it. They react to it. They place it beside their own work and decide whether it changes anything. That is the cost of becoming useful. Your judgment no longer stays inside the firm. It leaves with your name attached. A rating, a downgrade, a cautious note before earnings, a change in target price, a small accounting adjustment that looks technical to outsiders, but changes how serious investors understand the business. Each one becomes part of the record. And the record does not care how complicated the decision was. The buy side can use your work in many ways. They can agree with it, they can ignore it, they can modify it. They can trade against it, or use one paragraph while rejecting the rest. But the original call remains yours. Your name sits beside the judgment before anyone else decides what to do with it. This is where the incentives begin to press against each other. The client wants accuracy. The firm wants revenue. The company wants its narrative understood favorably. The banking side of the institution may want a relationship protected. None of these pressures have to arrive as an order. Most of the time, they do not. They arrive softly. A question about timing. A meeting with no clear agenda. A reminder that a company is important to the firm. A conversation that never asks you to change the conclusion, only to think carefully about when and how it is expressed. That is how pressure often works inside financial institutions, not as a command, as atmosphere. You learn that public accountability is not only about being right. It is about knowing which forces are present when you decide what truth is ready to carry your name. And after you have felt those forces enough times, another realization appears. The higher level is not simply writing better research. It is understanding the system that produces research before the market ever sees it. Level 8. The research infrastructure owner. At the 8th level, your name may appear less often, but your responsibility expands. You are no longer only the person making the call. You are responsible for the environment in which calls are made. The analysts, the associates, the hiring decisions, the training, the budget, the legal review, the client exposure, and the internal pressure that has to be contained before it bends the work. A young analyst wants to publish a strong note before the market fully understands the risk. Legal asks whether one sentence needs to be softened. The client team wants the note out quickly. Someone from banking does not tell you to delay anything, but asks whether today is really the right time. This is the level where the machine becomes visible. You begin to see research as infrastructure, not a report, a process. A system of people, incentives, permissions, controls, and judgment moving through an institution before it becomes a sentence in front of the market. You decide who is ready to speak to important clients, who needs more time inside the data, which sectors need more resources, which notes should slow down because the evidence is not strong enough, which conflicts need to be managed before they become invisible compromises. At this level, the public credit is smaller, but the structural responsibility is larger. The report may carry someone else's name. The client may remember someone else's call. The ranking may belong to an analyst you trained, but the quality of the machine reflects the structure you built. That is the final shift. At the lower levels, you protect the model. At the middle levels, you build trust. At the higher levels, you carry influence. But at the top, you protect the conditions that allow judgment to remain useful under pressure. Final inversion. The report is not the machine. From the outside, equity research seems to end when the report is published. The note goes out, the rating is updated, the target changes. The market absorbs it, agrees with it, rejects it, or moves past it. But inside the system, publication is not the end. It is the point where research leaves one machine and enters another. It enters portfolio meetings, risk discussions, client calls, trading decisions, commission relationships, company conversations, internal politics. It becomes part of how capital explains its own movement. A report does not move money because it is beautifully written. It moves money when someone trusts the judgment enough to act, to reduce exposure, to defend a position, to challenge a consensus view, to ask a better question before the market does. That is the part no ranking can fully measure. The highest level is not having the strongest opinion. It is not having the cleanest model. It is not having the biggest client list. It is not having the best ranking. It is not having the highest compensation. The highest level is understanding what happens after a judgment becomes usable. Equity research is where accuracy becomes trust. Trust becomes access. Access becomes influence. And influence, if you follow it far enough, forces you to see the structure behind the sentence.